You're applying for an apartment. It's a Tuesday afternoon. You found a decent one-bedroom in a okay neighborhood, $1,450 a month. You fill out the application. Employment verification, references, the usual. And then there's the line. Credit score required. Minimum 650. You pull up your score. 680. You're good. You qualify. You submit the application. But here's the thing that's nagging at you. You've never missed a reg payment. Not once in 6 years. You've been paying $1,350 a month, on time, every month for 6 years. That's $97,200 you've paid. Perfect record. Your credit score doesn't know that. Rent doesn't report to credit bureaus unless you're late. So those 6 years of perfect payments, invisible. They don't exist in the system that's judging whether you're responsible enough to pay rent. Meanwhile, your friend who's terrible with money but has 3 credit cards they rotate balances on, their score is 720, higher than yours. Because the system doesn't measure financial responsibility. It measures something else entirely. My name's Peter, and if you've ever felt like your credit score doesn't actually reflect how good you are with money, and you want to understand what it's really measuring and who it's really serving, make sure you hit that subscribe button. Because the credit score system isn't designed to help you. It's designed to profit from you. So let's start with what your credit score actually is versus what people think it is. Most people think a credit score measures financial responsibility, how well you manage money, whether you pay your bills, whether you're trustworthy with financial obligations. That's not what it measures. A credit score measures one thing, how profitable you are to lenders. That's it. It's a prediction of how much money banks and credit card companies can make off you over time. And the way you maximize that score often runs directly counter to actual financial health. Here's how the score breaks down. 35% payment history, whether you pay your credit accounts on time. 30% credit utilization, how much of your available credit you're using. 15% length of credit history, how long you've had accounts open. 10% credit mix, whether you have different types of credit. 10% new credit, recent applications and accounts. Notice what's missing? Your income, your savings, your net worth, your actual ability to pay? None of that factors in. You could have $200,000 in the bank and a 580 credit score because you don't use credit. Or you could be $40,000 in debt with $800 in savings and have a 760 score because you're managing that debt in ways that generate profit for lenders. The system isn't measuring your financial health. It's measuring your value as a customer to the credit industry. Now let's talk about what it costs you to maintain a good score. You've got 3 credit cards. You don't need 3 credit cards. You could do everything you need with a debit card. But you've got 3 because having multiple accounts with available credit improves your score. You keep small balances on them, not because you can't pay them off. You can pay them off today. But you've heard that keeping a small utilization ratio looks better than having 0 balances. So you carry maybe $400 across the 3 cards. That $400 is costing you $60 a year in interest at 15% APR. You're paying $60 a year to maintain a good credit utilization ratio. You're literally paying to have a good score. Then there's the annual fees. 2 of your cards have annual fees, $95 each. That's $190 a year. You keep them because closing old accounts would hurt your length of credit history and your available credit, which would hurt your score. So you're paying $190 a year to keep accounts open that you don't actually need just to maintain the score. Add it up, $60 in interest, $190 in fees. That's $250 a year you're spending to have a good credit score. Over 10 years, that's $2,500. Over 20 years, $5,000. Over your lifetime, probably $8,000 to $10,000, just in the direct costs of maintaining the score. And that doesn't include the opportunity cost. That $400 balance you're carrying, if you paid it off and invested that $400, it would grow. Over 20 years at 7% returns, that $400 becomes about $1,550. You're sacrificing investment growth to maintain a credit utilization ratio.
Most people think building credit is about demonstrating responsibility. Get a credit card, use it responsibly, pay it off, build your score. That's what you're told. But here's what's actually happening. The credit score system is designed to train you to be a profitable customer. It rewards behaviors that make you valuable to lenders and penalizes behaviors that don't. Paying your rent on time every month for years doesn't help your score. Not reported. But getting a secured credit card with a $500 limit and making minimum payments on a $200 balance, that helps because that generates interest revenue. Saving $20,000 in an emergency fund so you never need to borrow money doesn't help your score. Might even hurt it if you're not actively using credit. But taking out a car loan you don't need and making payments on it for 5 years, that helps because that generates interest revenue. The system teaches you that the way to prove you're financially responsible is to borrow money you don't need, pay interest on it, and manage that debt over time. That's literally the opposite of financial responsibility. It's like a system designed by casinos to measure how good a gambler you are. They don't reward people who don't gamble. They reward people who gamble consistently, manage their losses well, and keep coming back. The best customers aren't the ones who win big and leave. They're the ones who lose slowly over time and keep playing. Your credit score works the same way. The best score doesn't go to people who avoid debt. It goes to people who use debt regularly, manage it well enough to keep paying, and generate steady revenue for lenders over years. Here's the psychological mechanism that makes this particularly insidious. It's called manufactured necessity. The system creates a need for something that didn't naturally exist, then makes you dependent on it. You don't actually need a credit score to live. You can pay cash for a car. You can save for a down payment and get a mortgage through manual underwriting based on income and payment history. You can rent from landlords who don't require credit checks. But the system has made credit scores feel mandatory. Every apartment application requires one. Every loan application requires one. Every major financial decision gets filtered through this 3-digit number that you spend years building and maintaining. And once you're in the system, you're trapped in the maintenance cycle. You can't let your score drop because you need it for the next apartment, the next car, the next whatever. So you keep playing the game, keep carrying balances, keep paying fees, keep using credit you don't need. The cost of opting out feels higher than the cost of playing along. So you play along. And that's exactly how manufactured necessity works. You're lying in bed. It's 3 a.m. on a random Wednesday, and you're thinking about that credit card offer that came in the mail. 0% APR for 18 months, $200 sign-up bonus if you spend $1,000 in the first 3 months. You don't need another credit card. You've got 3 already. But that sign-up bonus is real money, and opening it would increase your available credit, which would lower your utilization ratio, which would probably bump your score up a few points. You're doing mental math. Is it worth it? The new account will slightly hurt your average age of accounts, but the utilization improvement might offset that. And if you're applying for a mortgage in the next 2 years, every point matters. This is the game. You're optimizing for a number that doesn't measure your financial health. You're making financial decisions based on how they'll impact your score, not based on whether they're actually good for you financially. And that tightness in your chest, it's not about the decision. It's about the realization that you've been playing this game for years without questioning whether the game makes sense. So here's how people who actually understand the credit system think about it differently. And this isn't about abandoning credit entirely. It's about using the system strategically instead of letting it use you. They recognize that a credit score is a tool, not a goal. The goal is financial stability. The score is occasionally useful for accessing that stability, but it's not stability itself. So they don't optimize for the score. They optimize for actual financial health and accept whatever score results from that. What does that look like in practice? They don't carry balances to maintain utilization ratios. They pay cards off completely every month. If that means their utilization is 0, fine. They're not paying interest to game a number. They don't keep accounts open just for credit history if those accounts have annual fees. They do the math. Is the fee worth it for the benefits, regardless of what it does to the score? If no, they close it. The score will recover. They don't take out loans they don't need to build credit mix. They borrow when borrowing makes financial sense and not a moment before. If that means they only have credit card accounts for 10 years, so be it. And here's what actually changes when you think this way. You stop making financial decisions in service of a number. You start making decisions in service of your actual financial goals. And weirdly, your score often ends up fine anyway, because the behaviors that create real financial health, paying bills on time, not over-leveraging, being consistent, happen to overlap with some of what the score rewards. But more importantly, you stop spending money to maintain the score. That $250 a year in interest and fees, gone. That's $2,500 over 10 years that stays in your pocket or gets invested instead of going to banks. Now here's the part that makes people uncomfortable. The credit scoring system exists because it's profitable. For credit bureaus, Equifax, Experian, TransUnion,
It's profitable to sell your data, your score, your history, your behavior. They sell that to lenders, to landlords, to employers, to insurers. You're the product. Your financial behavior is the commodity, and you don't get paid for it. They do. Every time you apply for an apartment and the landlord checks your credit, they're paying the credit bureau for that report. You're generating revenue for the bureau just by existing in the system, and you don't see a cent of it. Actually, it's worse. You pay to access your own score. You can get one free report per year from each bureau, but if you want to monitor your score regularly, like the system tells you should, you pay for that. Services like Credit Karma are free because they're monetizing you differently, selling your information to lenders who then target you with offers. The whole ecosystem is designed to extract value from you at every possible point, while convincing you that you need to participate in it for your own good. And here's the thing. In the current system, you kind of do need to participate. Try renting an apartment without a credit check. Try getting a mortgage without a score. It's possible, but it's harder. The system has become the default, so opting out carries real friction. But recognizing that the system is extractive doesn't mean you have to optimize for it. You can participate minimally. Use credit when it makes sense. When you want purchase protection, when you're getting actual rewards that exceed any costs, when you need a large loan at a competitive rate. But don't contort your financial life to serve the score. Let's talk about what credit scores actually cost society, not just individuals. The credit scoring system creates a two-tier economy. People with good scores get access to credit at reasonable rates. People with bad scores get predatory rates or no access at all, which keeps them in financial distress, which keeps their scores low, which keeps them in the high-cost tier. It's a poverty trap. If you're struggling financially and miss a payment, your score drops. Now you can't access affordable credit. So when an emergency hits, you're forced into high-interest options, payday loans, subprime credit cards at 24% APR, rent-to-own schemes. Those high costs make it harder to get ahead, which makes you more likely to miss another payment, which drops your score further. Meanwhile, someone who's financially comfortable makes their payments on time, maintains a good score, gets offered credit at 5% APR, and the gap between them and the struggling person widens. The system doesn't help people climb out of financial difficulty. It entrenches the gap between those who have financial stability and those who don't. And it does this while pretending to be objective. It's just a number, right? Just math. But the math is designed around behaviors that correlate with wealth. Having multiple credit accounts open requires having enough financial bandwidth to manage them. Keeping utilization low requires having more available credit than you need. Building long credit history requires starting young, which often requires family support or financial literacy that's not equally distributed. The system presents itself as neutral, but it's measuring behaviors that are easier for some people to achieve than others, based on starting conditions that have nothing to do with their actual reliability or responsibility.
You're at a coffee shop. Saturday morning. You run into an old college friend. You're catching up. They mention they just bought a house. You congratulate them. They say something about locking in a good rate because their credit score is 780. You make a joke about credit scores being a scam. They look at you confused. But mine got me a great rate. It saved me thousands. And you realize they don't see it. The score helped them, so the system must be good. They don't see that the system helped them because they were already in a position to play the game well. They don't see the people the system is quietly crushing. You don't say any of this. You just smile and change the subject. But the conversation stays with you because that's how systems stay in place. The people they benefit, defend them. The people they harm, can't afford to fight them. Here's what actually changes when you see the credit system clearly. You stop treating your score like a measure of your worth. It's not. It's a measure of your profitability to lenders. Those are not the same thing. You stop making financial decisions based on what's good for your score and start making them based on what's good for your actual financial health. Sometimes those align. Often they don't. You stop feeling guilty when your score drops because you paid off all your credit cards or closed an account with an annual fee. You're not failing at credit. You're succeeding at managing money, and you start seeing the system for what it is, a tool that's occasionally useful, but fundamentally designed to serve lenders, not you. You use it when it benefits you. You ignore it when it doesn't. You refuse to let it dictate your financial decisions. Now, let me be very clear about something. This doesn't mean you should tank your credit score on purpose or refuse to engage with the system entirely. In the current economy, having a decent score makes certain things easier. Getting an apartment, getting a car loan if you need one, getting a mortgage. But there's a difference between having a workable score and optimizing your entire financial life around maximizing it. The first is pragmatic. The second is expensive and unnecessary. And here's the thing most people miss. You can have a perfectly good score, 700, 720, plenty high enough for normal life,
without carrying balances, without paying annual fees, without playing the optimization game. You just need 1 or 2 credit cards that you use for normal purchases and pay off every month. That's it. That's enough. A whole ecosystem of credit score optimization. The apps, the monitoring services, the strategies, the mental energy. It's mostly theater. It's making you think you need to actively manage this thing, when the reality is you just need to pay your bills on time and not overextend yourself. Everything beyond that is largely a scam, a way to extract attention and money from you in service of a number that you've been told matters more than it actually does. So here's the thing about credit scores. They're not a measure of financial responsibility. They're a measure of your value to the credit industry. And the system is designed to convince you that serving that value is the same as serving your own interests. It's not. Often it's the opposite. The financially stable people aren't the ones obsessing for their scores. They're the ones who pay their bills, avoid debt they don't need, save aggressively, and let the score be whatever it ends up being. The score is a byproduct of financial health, not the source of it. But the system has spent decades convincing you otherwise, convincing you that the number is what matters, that optimizing for it is responsible, that participating fully in the credit economy is the path to financial success. And meanwhile, you're paying $250 a year in interest and fees to maintain a number that mostly serves to make other people money off of you. The question isn't, how do I get my score higher? The question is, what is this score actually costing me? And is it worth it? For most people, the honest answer is, more than you think, and probably not.